Hello, welcome to this online session from Impact Taxation and Financial Services. Okay, in today's topic, we'll have a look at the three most costly tax mistakes when selling a property. All right, before we go to the main content, I just want to mention that the information provided here is for general information only. Before making any decision, please consult with an experienced tax agent. All right, let's have a look. The first possible mistake. Yeah, we actually combine a few different mistakes together. So mistake number one is incorrect timing of sales. So incorrect timing could be related to a few different things. Yeah, so let's have a look at one by one. So the first one, when selling multiple properties with capital gains in the same tax year, you will pay a lot more capital gains tax. Okay, you might already know this. Yeah, if in case you don't know about this, because capital gains tax is calculated by adding all your gain on top of your other income on your marginal tax rate. Yeah, so that means the more other income you have, the more marginal tax rate you have, you actually pay more on capital gains tax. So we had an example. Yeah, I remember a couple of years ago, a client mentioned, "Oh, I want to sell 3 properties before June." Okay, I remember it was in April, and then all 3 are going to give him capital gain, and then by convincing him to postpone 2 out of 3 property sales to the following tax year, just move to July. Okay, from June to July. Then he saved $80,000 on capital gains tax. Yeah, so this is very important. Yeah, that's why it can be really costly. Yeah, so you want to spread your sales to different years, especially sometimes, say, if you stop having other income, or maybe you have a gap year, you go travel somewhere and then you stop working for a year, then you might want to choose that year to sell a property, or maybe when you retire. Okay, that's actually what we mentioned here. Choosing to sell in a year you earn minimum income would help you to save a lot on tax. Yeah, because of that. All right. Or okay, the second possible mistakes on timing. Okay, selling inherited owner-occupied properties in 2 years will get you CGT exemption. Yeah, so the possible mistake related to that could be someone, if they didn't know about this, they actually sell outside that 2 years. Yeah, you could have the exemption. All right. And then also non-tax resident will have to pay capital gains tax for main residence properties after leaving Australia. So that's also important. So once you're not a tax resident for Australia, you don't have the exemption, yeah, for main residence. Okay, so if you're a tax resident in Australia, for your main owner-occupied residence, you actually have a capital gains tax exemption. But if you're not Australian tax resident, then you don't have that exemption. So you just need to make sure if you're going to move to a different country, you're going to leave Australia, then the timing is actually important. If you are considering selling a property, you'd better sell before you leave Australia. All right, and then also GST payable for new properties up to 5 years or more than 5 years if it has been actively marketed for sale. So this is something a lot of people don't know. So when you're building a new property, or ATO actually classifies some other properties as new properties as well. When you're adding major additions, or when you did major renovations to an existing property, ATO might treat it as a new property as well. So when you have a new property or you build a new property for 5 years, okay, if you're selling it within 5 years, you actually need to pay GST. Yeah, so this is important. But outside 5 years, okay, unless you're actively marketing the property for sale, yeah, outside 5 years, you don't need to pay GST when you're selling it. So the timing is critical here as well. All right, and then I also added a small note here, other notes on timing that a lot of people might not know. When you're moving houses, for your main residence, you can treat both houses as main residence up to 6 months to claim CGT exemption. If you're meeting ATO requirements. So ATO actually has some other requirements. So basically, if there are any reason, you know, when you're buying and selling, your new house might be held up, by the tenant, for whatever reason, or you just can't move in, So if you're meeting ATO requirements, then potentially you can actually hold both properties as main residence to claim CGT exemption for up to 6 months. All right. Let's have a look at mistake number 2. All right. So also on incorrect timing. But this time it's actually on repair and maintenance. Okay. So we actually mentioned about this in multiple other seminars, but that's mainly related to purchasing. Okay, when you purchase a property, you need to be careful that you need to organize repair maintenance when the property is available for rental. So let's have a look at the theory behind. Okay, so genuine repair and maintenance expenses are deductible against the rental income when the property is available for rental. So available for rental is actually a concept. I just want to make a note here, is when the property is advertised as available to be leased. Okay, so even sometimes you don't really have to have a tenant there. So if for that period of the time you advertise the property as is available for renting, okay, then that means it's available for rental. So when you have genuine repair maintenance, okay, genuine repair maintenance need to be it can't be capital expenses such as when you're replacing the whole unit. So one example sometimes I mention, say for example for wooden floorboards. Okay, if you have a hole, with a few of them and you replace a few boards, that's repair maintenance. But if you rip off the whole floor, then you replace everything, that's actually capital. That is not a genuine repair maintenance. Then when it's capital expenses, you need to, or we need to help you to calculate depreciation for different years, based on the asset life. All right. So basically, this happens to a lot of people. Before you sell the property, to make the property look more presentable, you might go in and do a lot of repair maintenance. You do a lot of renovations, and then, so the key part here is if it's done when it's available for rental, you can claim a deduction for income tax against the rental income for that tax year. Okay, so if it's done when the property is not available for rental, okay, the cost will be forming a part of the cost base deductions for capital gains tax calculations. So what's going to be the impact? Okay, there's a major difference. So let's say if you're going to have a capital loss when you sell the property, okay, let's say if you spend $5,000 on genuine repair maintenance. So basically that $5,000, if you did it when the property was not available for rental, you have to combine it as your cost base. Basically, the capital loss will be increased by $5,000. Okay, then the issue here is that for capital loss, you have to postpone it to the future years until you have a future capital gain to use it. Okay, so that's the key part. So that means that $5,000, you don't know when the deduction is going to happen, because you have to wait maybe many years until you do have some capital gain. If you never have any future capital gain, then it's just forever lost. All right, so that's a first scenario if you have a capital loss when you are selling the property. Okay, second scenario, what if you have a capital gain? So with capital gain, you actually have 50% discount. So of course, provided if the property is under your name or maybe under a family trust, okay, and then distributed to you on the capital gain. and then there is actually a 50% discount on the capital gain. So that means, let's use that example we mentioned earlier. If you spend $5,000 on general repair and maintenance when the property was available for rental, then you actually claim $5,000 deduction in your rental income in the tax year. Okay, and then of course with your rental, if you have a rental loss, you can actually use that loss to reduce other income to reduce your overall tax as well. Okay, so that's why that $5,000 could be quite important for you. And then, but if you combine it in capital gain, okay, as a deduction for capital gain, if it was not done when the property was available for rental, then after the capital gain tax discount, okay, you only claim 50% of the deduction. So that means you're reducing the deduction from $5,000 to $2,500. All right, so this is important. So either way, if you have a capital loss on the property or capital gain, you don't want to, or if you do have genuine repair maintenance, you would rather to have it done when the property is available for rental. All right, so this is something really important. All right, so let's have a look at mistake number 3. Okay, so this is actually related to misunderstanding main residence exemption. All right, so okay, first example here, 6-year rule we have mentioned in multiple other seminars as well. So it could actually help you to save capital gains tax after you move out from the main residence property. So remember, for main residence, yeah, you actually have a capital gains tax exemption. So that it happens quite a lot to people after they move out. They might, say, for an example, have an overseas posting for a job. They rent out their property. Yeah, if they rent out for less than 6 years, if they sell it within that 6 years, they can still get that capital gains tax exemption for the main residence property. Okay, this is important because a couple of years ago, we actually did a big amendment for a client. Yeah, because he didn't know when he did the tax return himself that he actually reported this one, and then he paid capital gains tax, yeah, for the portion, yeah, of the time of the property that he actually rented out. So we actually helped him to do a major amendment. Okay, and then the second mistake, okay, possible example, renting out part of your house or utilize it to generate business income will cause capital gains tax for that portion of the property. Yeah, this one a lot of people don't know as well. Yeah, that's probably it need to get involved a little bit planning in advance. Yeah, so before you rent out part of the house or before you utilize it to generate business income, potentially use it as a home office, you might want to consult with a tax accountant, yeah, to see what's going to be the tax impact for doing it. Yeah, it happened once before that one of our clients actually also reported the capital gain incorrectly. Yeah, we had to help him to do an amendment. Yeah, because he didn't report the part that he rented out to as a part of the capital gain, and then pay capital gains tax. All right, so that's mistake number 3. Of course, so we have grouped. If you noticed, yeah, we have grouped different mistakes in different groups. Yeah, so potentially there can be multiple mistakes under different, different mistake groups. Yeah, but so I guess the main thing is you need to plan early. Yeah, talk to a tax accountant to understand. All right, so this is where I want to reiterate again. Yeah, so you want to plan earlier or understand the related tax law requirement. We do have multiple YouTube videos to help you to learn, yeah, to avoid the common mistakes. Yeah, so they're all on our YouTube channel. So make sure you watch them and let us know if you have any questions. Right, okay, the keynote, I added it here again. Plan earlier to avoid costly mistakes. Consulting with a good tax accountant before you sell could help you to save tens of thousands of dollars. All right, and here is a brief introduction about myself, and we have our contact details here. If you have any questions, please don't hesitate to let us know. Thank you for attending today's session. I will see you next time.